All right, we're ready to go. Good afternoon, everyone. I'm Steve Kruskis. I head up the Global Transaction Advisory practice at EY, and welcome to our Investment Outlook panel. Just to set the stage, if you think back on the last day and a half, we've talked about opportunity, we've talked about synchronized global growth, we've talked about opportunity from technology and data, but we spent a lot of time talking about risks, geopolitical, trade, emerging market contagion, rising interest rates, monetary tightening. And to be honest, I left yesterday probably slightly less optimistic than when I came in. But then you sit back and you think about how much private capital is in the market today. And we all know that fundraising continues at a record pace. And if I reflect back on my career 20 years ago, clients would ask me in reference to private equity, where's the money going to come from? Is this sustainable? And now, of course, as you know, the question is not where does the money come from, but where is the money going to go, right? And that's a little bit what we'll try to talk about today. We've got three legends of the investment world with us today, and if anyone can help answer that question, I know these three gentlemen can. So let me do quick introductions. First of all, David Bonderman. David is the founder of TPG. You're all familiar with TPG, one of the largest and most successful and most diversified private equity funds in the world, $80 billion under management. I think it's fair to call David one of the architects of the modern private equity industry and one of the most iconic figures in that industry. A couple of probably less known facts about David. He was an attorney earlier in his career, actually won a case at the US Supreme Court, which I think after you've done that, you're probably ready to move on to private equity. David also, hopefully, in a couple of weeks, will be the owner of a professional ice hockey team in the US, so we'll keep an eye out for that. David is, I think as you all know, very well known and highly regarded for his work around philanthropy as well. So David, thank you for being with us. Now, if I can move to Brian Sheff. Brian is the co-founder and president of Vista Equity Partners. Vista, and some of you may know this, some may not, one of the most successful track records in the world in private equity. Vista focuses entirely on enterprise software. They are, if you add the numbers up, the fourth largest software company in the world. Only Microsoft, Oracle, and SAP, I think, are larger. Vista has never lost money on a buyout deal, so that's something to be very proud of.
Is there wood around here?
Brian was named by Forbes as the billionaire who is the biggest deal maker in software. That's a pretty high honor. He's also one of the few people that have ever been named to both the Forbes and Fortune 40 under 40 list in the same year.
Sadly, a long time ago.
And Brian is also very well known for his work around philanthropy, as well as conservation, the environment, and in fact, another little known fact, Brian actually has a new species named after him to show you how important his work is around conservation. Now I'll move to Michael Carmen. Michael is a senior managing director and partner with Wellington Management. Michael heads up the private equity, oversees the private equity portfolio at Wellington. He has one of the most successful track records in the world in portfolio management. I wish I had taken some of his advice back from a few years ago. Wellington has over $1 trillion of client money under management. And Michael was one of the first portfolio managers to identify the trend of staying private longer. So that's something we'll get into a bit today. Fun fact about Michael, he's been to over 40 Bruce Springsteen concerts. So that's pretty cool. So this is a fantastic and a fun group. Now, what I'd like to do, and we agreed as a panel, is we're going to dive into a few key areas that we think helps answer the question as to how this investment landscape shapes up over the near to medium term. We'll do that, then we're going to try to hit 10 minutes of audience Q&A. And we talked about it as a panel, very important to us and to these three gentlemen. They hear your views, so please think about the Q&A, and we'll dedicate 10 full minutes to that. Then we're going to come back for a lightning round and ask them to put it all together and what it means in 60 seconds or less. So that'll be a feat. All right. The first theme that we think is really important to talk about related to this topic, the investment outlook, where money is going, is technology. Because the impact of technology is so pervasive. There was a comment on one of the panels yesterday that the upside from technology, data, AI is greater than the downside from geopolitical risk, if you look at the economic backdrop. So Brian, a three-part question. First is that true or false? Is the upside from technology bigger than the downside on geopolitical? And secondly, where do you see the big pockets of opportunity for investing and M&A across tech? And third, I'd love to go into tech to non-tech and where you see the big opportunities there.
Okay, great. Well, thank you for having me, and thanks for teeing me up in the middle of fundraising. So, I think the short answer is yes. Of course, we at Vista certainly think so. The great opportunity for us is in enterprise software. Last week, there was a study cited by CNBC that 60% of CFOs identified access to IT talent as their number one concern, greater than access to capital markets. So the headline was, "Software is more important than money," which is hilarious because nothing's more important than money, as we all know. But the important thing to realize now is that non-tech people within organizations recognize, how important and how dangerous technological obsolescence is. And as my partner Robert likes to say, if you don't think your industry is getting transformed by technology, then it's probably already happened. We are in the middle of what we like to call the fourth industrial revolution, and it involves the digitization of everything that we do. And the great investment opportunity, and I think all of us are involved in it, is identifying the winners in technology that are going to help us as we navigate this transition from what we like to call an analog economy into a digital one. And just like 100 years ago, it was you were transitioning to an electrified economy. You didn't ask people whether or not they were an electrified company or not. I think in the same way, very shortly, we're not going to ask people if they're a digital or a software business. They're just going to be a business. And I think part of the reason why these CFOs identified access to talent as such an important part is many of them don't come from a technology background. And I think it's going to be harder and harder for C-level executives across the world who manage businesses regardless of industry to not have a technical background, because it's just the lexicon of the future, and it's the way that their businesses are being transformed today. So in software, part of what makes it so exciting for those of us who invest in software is it's the largest part of the technology industry, which has changed a lot. When we started Vista 18 years ago, it was 10% of total technology spend. Now it's over 50%, and it's growing faster than the overall IT budget. It's a $1 trillion industry, but unlike a lot of big industries, it's not dominated by big companies. And even though we are the fourth largest software company in the world collectively, that $16 billion of revenue is a drop in the bucket compared to the global technology industry, just as Microsoft with $100 billion is a drop in the bucket. And so the reason why that is companies and customers recognize that the productivity of software is fundamentally different than any tool that they have, and you mentioned this earlier. The return on investment for software is roughly 700%, and it eclipses that of things like management consulting, contracts, Six Sigma, for those of you who remember what that is, investments, and investments in things like clean energy and revamped infrastructure. And so because it is so productive, companies put up with the fact that there are so many software vendors. So the reason why we think it's perfect for private equity is we've identified over 40,000 companies around the globe with more than $10 million in revenue that provide software and IT services. The average enterprise customer of ours has over 1,800 software vendors. Now, they might have 2 or 3 for furniture and 1 or 2 for other aspects of their purchasing, but on average, they have 1,800 software vendors. And so that opportunity to buy leaders in niche products is a great one. And then what Vista does is really transform many of these companies that are built on products and help them become great businesses, because so many of these companies are run by founders. I'm not sure if I answered any of your questions, but thanks for letting me talk.
Well, I think you did. Look, I think you did. I guess at the end of the day, none of us really can quantify the geopolitical risk, and some of the other risks, but there is no question that the opportunity around technology, and to your point, it touches every industry. I didn't hear you pick any one particular, but
well, you know, the part of what's going on in the United States, for example, where I live, is that, you know, there's tremendous concern around what the impacts of technology and its dissemination in kind of the broader economy. But one of the things that Mike told me last night, in the last 3 years, Amazon has invested in an additional 75,000 robots in their warehouses. And over the same time period, they've increased their employee count by 60%. So technology really enables us to do more and be more productive, and it allows us to create new opportunities. In the 90s, everyone was worried about the first wave of software. It was going to outmode everyone who was in kind of the manual workflow positions, people in accounting, people in accounts payable. And many of those jobs did go away, but employment expanded.
That's right.
And there were new opportunities that were being created. And when people ask me about AI and whether or not we're concerned, I say absolutely not. The interface that we're all used to in software and technology is very much a manual one. If you're involved in enterprise technology at all, you all know that, you know, we input all this stuff in a very 20th century way. And part of what AI is going to help us do in machine learning is interact with technology in a much more intuitive fashion. And that's going to make all of us more productive, and it's going to help us create a whole new succession and cycle of wealth and prosperity. And I'm very optimistic.
Yeah. Well, I think, you know, every industrial revolution, at least the first 3, have created jobs. I expect this one will too. David, you spent a lot of time and spend a lot of time around telecom and media through TPG growth and TPG more broadly. If you think about the convergence of those sectors, and you know, I've heard you talk about iFlix, for example, which is a pretty very interesting company. How do you see that playing out? Who are the winners, and where do you put your bets around convergence?
Well, first of all, I'd like to thank you all for coming to listen to our opinions here. It's now my turn to not answer your question. Now, I agree with much of what Brian said. We are maybe the 2nd or 3rd largest private equity investors in software. And we've done it a little more broadly. These guys have hit a fabulous business model because there is no better returning asset class than software. But we have diversified a little more. We do a lot of media-related things. And the difference between the question you asked, Brian, and his answer, having to do with the geopolitical forces involved. We have a situation where AI is coming. It's here in some ways, but it's got a long way to run. The same is true with a lot of the software products that Brian and others of us invest in. What is more dangerous, though, is the geopolitical risk, which is happening now. And we're all going to be around, or we're not going to be around, based upon how the geopolitical risk turns out here in this country, in Southeast Asia, elsewhere, in the United States. So we tend to look for things which are apolitical. You know, in your introduction, you said words to the effect of, is there too much private equity? Is there too much money? So as a matter of fact, there's always too much money in private equity, and the winner is always paying too much. But somehow, with that backdrop, the asset class has returned more than any other asset class that people have been able to dream up. So is there risk? Yes. Is there geopolitical risk? Yes. Is there a lot of capital around chasing things? Yes. Are prices high? Yes. But somehow it always works out. There's going to be a bump along the way. There always is. But if you have to put your money somewhere, call up Brian and see if what he's got going.
Well said. Michael, do you want to weigh in on this one, on the technology topic and how Wellington thinks about it?
Sure, yeah. So I'm going to try to answer maybe one of the questions that you asked. But I think the level, what I've found in terms of what we've been doing is that the level of disruption in technology, having covered it for almost 30 years, is greater today than we have ever seen in our history in terms of companies that have been able to scale at levels that it took companies 10, 20, 30 years. You think about a company like Uber, which created a category that nobody even knew that they needed and is now doing tens of billions of dollars of gross merchandise value every year. Or you think about a company like Airbnb, where if I came out to all of you and I said, listen, I got this great idea. I'm going to create this company that's a platform. And I'm going to match up people so that people can stay in your spare room that you've never met before. You'd say, like, that is like super creepy. And I'm not going to do that. And that's a company that's doing tens of billions of dollars of gross merchandise value this year. And so what we've been looking for and what we've been seeing in this market is that these platforms can leverage and grow way faster than ever before. For the first time ever, we had a company called Apple that pierced $1 trillion in market cap. Amazon is now $970 billion in market cap. Facebook, which started just a little over 10 years ago, is now $500 billion in market cap. And so the ability to scale on a platform, whether it's the internet or others, has just created this opportunities that we've never seen before because of the fact that people have 3 billion handsets or smart computers in their hands, which is going to 5 billion, has just transformed what we've seen and has allowed people to leverage their businesses like never before. So this, to me, even though I've been doing this for 30 years, this seems like the single most exciting time that I've seen in the technology sector. And I don't think it's going to slow down. We'll have corrections along the way. We'll have even bear markets along the way. But I see those as all major opportunities to take advantage of the best transformation I've seen in my career.
Could I just chime
Please.
in for one moment here? One of the things that is usually different this time than the other industrial revolutions that have occurred is that this one is not capital intensive. You had to build electric power plants. You had to build railroads. You had to put up a lot of capital to cause change in those previous revolutions. You don't need to put much capital to buy a software company or to build one. And in matter of fact, if you go back and look at the history, all the guys who built the railroads and changed the world, they all went broke. The second and third owners, just like in some real estate business, second, third owners, they did great. But the guys who made the revolution didn't do so great at all. Here, it's quite different, and very importantly different.
Yeah, that's a good point. Just to follow up on that point, I think it's a great point. And what's happened is that because of Amazon and AWS, that you have a credit card, you can start a business. And so where the capital has gone to customer acquisitions. And so this is where Google and Facebook have just been transformational for companies that are starting out, particularly in the consumer space, because they are a place where you have 2 billion to more people that you can market to. And so we've seen companies in our portfolio that have been able to ramp way faster than the last generation because they didn't have to open up one store at a time and put a lot of capital in. They just needed to acquire customers online by having the right keyword or targeting the right customers. And that's been a huge difference in companies' abilities to leverage the platforms.
Absolutely. Brian, you mentioned an important point early on, and that's management and the technological savvy of management, top management, CEOs. As you evaluate, I would ask this to all of you, as you evaluate businesses, whether they're tech or non-tech, is that a critical must-have, or can you change? You look at it as you can change management out if you need to, but
yeah, management in the software industry, it's a little bit table stakes. Understanding not only the product architecture that their own companies have, but because of the interconnectivity of all these different software programs today, understanding where their companies sit in the ecosystem is so important. Now, they don't have to know it all. And as you are very well aware, we have a big training program at Vista because we recognized a long time ago that there are very few places in software where people can get trained on these things. Most software companies, including the 3 biggest software companies in the world, are dominated by their founders. So even today, Larry Ellison runs Oracle, Hasso Plattner is the chairman of the board at SAP. Go down the list of all the biggest and smallest software companies, and they're dominated by founders. And founders are extraordinary. They have amazing energy. Not just saying that because I'm a founder. They're passionate. They have kind of a limitless optimism for what the future can bring, but they haven't been trained. And so part of what we have to do, because we only invest in software, is help train them. And so we build all the systems and whatnot that you and the folks at EY know really well. And I think it's important, whether you get trained by Vista or otherwise, to recognize that you can't just be a product genius in technology. The world has gotten bigger, and for all the reasons that Michael said and that David said, you cannot exist by yourself isolated in technology anymore. And there is no product, whether it's hardware or software, that doesn't interact in some fundamental way. And as we, with other technology, and as we continue to go along in cloud computing and everything is going to be more interconnected, that technological savvy that you asked about is going to be even more important. So whether you get your training from Vista or otherwise, you better bone up.
Good advice. And the point, David, that you made around less capital intensity in this industrial revolution, I think, is another one that maybe people don't think about as much as they should. All right, let's shift away.
There's one other point that ought to be made, which is software never works either.
Sorry?
Software never works. Have you ever seen a glitch-free software program? Did anybody ever install SAP and have it work?
Moving on.
No. The answer to that is no. And because of the nature of the almost, the difficulties of complexities of better software products, you get 2 and 3 chances often. If you built a car and the right wheel didn't work, you would be in trouble. You have a software program and you can't quite get the bugs out of it, you'd try again. So it's forgiving.
Excellent point. Excellent point. Okay. Let's shift away from technology. I know the audience may have more questions later. And I want to move to the evolution of private capital. And, Michael, many years ago, as I said earlier, you identified the trend of companies staying private longer, the benefits of that, which is probably, one of the reasons that, we see more demand for private capital. But there's also so many forms, right, of private capital today, and we've talked about these over the 2 days. Traditional private equity, venture, the corporate-based funds like Vision Fund or Alibaba's fund or Tencent, sovereign wealth, direct investment by the pension funds, and so on. How do you think about, well, first of all, do you agree that we're still in a world where it's better to stay private longer? And if that's the case, how do you think about those different options of capital providers?
Yeah, so first here, I think I want to bring you along the road with me because you're very complimentary to me, so I really appreciate that. So I need you to talk to my wife. So in terms of companies staying private longer, I do think this is a trend that is here to stay, and I think it's a huge trend that makes perfect sense. And when you go back and you think about the US market, when this started happening about a little bit over a decade ago, maybe 15 years ago, it was really driven by Sarbanes-Oxley. And with Sarbanes-Oxley, that raised the regulatory burden and the cost of companies going public. So it stopped making sense for companies at $200, $300, $400 million market caps to go public because the scrutiny level and the costs were very high. But what I have seen lately, and what I've seen in the companies that we've looked at, is that what's happened is that it just makes sense to stay private longer. Why go to the public markets when you're still at an immature state? Why go to the public markets when you don't have visibility on your outlook, when you're still hiring key parts of your management team? Why not take capital from whether it's ourselves or TPG and others and try things out, break things, make mistakes, pivot, go in different directions? And so whether you're the largest of these, like Meituan or Uber or Lyft or Airbnb that are staying private for 40, 50, $60 billion market caps, or your companies that are at a lower level, 1, 2, 3, 4 billion, if that capital is available, which clearly it is, as David said, there's lots of capital out there, you can really refine your model. And when we talk to our management teams at our companies, even though we're the capital that is the last round before they go public, we actually push our management teams to take their time and wait longer and really get your company to a state where you can really shine in the public markets and be more successful in the public markets. And so even though for a small cap growth manager it may be very frustrating, I think for the longer term, we're enabling companies to be better companies over the longer term and go out into the public markets at a much more mature state. And so I think that that all makes a lot of sense. In terms of the pools of capital that we're seeing, there's a lot. There are the sovereign wealth funds that are out there. There are crossover investors such as ourselves. There are the early stage funds like Sequoia and others who are starting to raise somewhat larger funds. There are large family offices. So there's many, many pools of capital. And so at the end of the day, it's a competitive environment. And as always, our job is just to try to pick the best of the litter. And I think that that's what we'll continue to try to do. But I think that this space is going to be one of the largest areas of the private markets as we move forward. And pretty much every company that goes public will have done a late stage round prior to their IPO.
Any comments, David or Brian?
Yeah, what Mike said is absolutely true. Could be emphasized a bit more is that for the first time over the last few years, there's liquidity in the private markets. And Mike alluded to that, but the point of it is you used to have to go public to raise capital. You needed capital to grow your business. You went public as a way to get your capital. Uber has raised umpteen $billion without ever thinking about going public. Airbnb is in the same situation, although a little less dramatically. We have reason to know. So that has made a huge difference in people's intent. And there are now whole firms whose raison d'etre is to provide liquidity. So you get the Wellingtons of the world, for example. I'm sorry, Wellingtons, Lexingtons of the world, who their entire business model is to buy secondary stakes. So you don't need to go public in many instances. And you don't have to put up with Sarbanes-Oxley. You don't have to put up with the various regulatory issues. You've got liquidity without being public. And that is a huge sea change. And part of that is because there's different kinds of capital, like family offices. And part of it's because guys like Wellington have changed their business model to be willing to do that. And when we compete to invest in a company, we'll often be competing against some multi-trillion-dollar operation of the Putnams, Wellingtons, Fidelities of the world, whose basic pitch is, we have lots of capital and we won't bother you. If you go do a deal with Vista or TPG, they're going to call you up and ask what's going on with the gross margin here. You do a deal with one of these guys, their promise is, we promise we'll never call you up and you'll never hear from us, just let us buy some stock, which has created additional liquidity. Yeah. And I'm a little cynical about it, but that's how it is.
Yeah,
I think the other thing, and I agree with everything these guys have said, the other thing is that, technology and software especially is founder-led. And the stuff is faddish. And when I started my career 20 years ago, it was a big deal for founders to want to take their company public. It was personal approbation. They were really excited about doing it, and it was something that their peers respected. And you don't hear that when you're in the Valley or in Boston or Boston. You know, that's not on the wish list of founders anymore. They have other things they want to do. They want to go to Burning Man. But so, and I think for so long as that's the case, you know, you have, you know, a huge major impetus of taking these companies public, especially in the old days when they took them public too early because the founder was so desperate to be a public company CEO. That's mostly gone away.
Yeah. You know, I was looking at some data this morning because Ronnie at the Milken Institute had asked me a question about U.S. private equity exits, and we see it every day, but it was just sort of stunning to look at the numbers and see how few public exits there were in the last 18 months.
We've never taken anything public, so we're pretty good at liquidity business, but 100% of our exits have been sales, strategic and financial. And for all the reasons that these guys pointed out, you just don't have to do it.
And one thing that I'll point out is that even though companies don't need to go public, and there's a lot of avenues for them to stay private, whether they go to private equity or or get bought by a larger company, we've made 56 investments over the last 4 years, and I have not met a CEO that we've worked with who didn't want to eventually become a public company. And so I think that desire, and in many cases the need, whether you're a consumer company and it's a branding event, or you're a software company and you need a currency, I think that the ultimate outcome for the companies that we're generally investing in the late stage space is that they still will go public. Now, it may turn out that they get bought by Vista or somebody else, but I think that they're still, their ultimate goal is to become a public company over the longer term.
I would say that increasingly you find some people who really take the position they don't want to be public. Some will take, you know, a 5-year window or something, but a lot of them will say, we just don't want to be public, we don't need to be public. They're not likely guys who you will want to invest in because you got to have an exit for your client base at some point. But there are companies like that. And the other thing increasingly we're seeing with the rise of sovereign wealth funds and the rise of family offices, because the nature of private equity is that it's midterm capital. We have to pay off the pensioners who fund us. You have a situation where guys who have a very long-term view don't want to be owned by private equity. They'll be owned by family offices, by sovereign wealth funds, other people who don't have a meter. And that is a rising change.
You know, when you think about the mega private equity funds, big private equity funds, I think all have the credit funds and, you know, can service all parts of the balance sheet. Do you see that trend creeping into any of the smaller funds, middle market, or not?
Well, I think the question is, you know, what are you offering as an investor to kind of the constituent base? You know, for us, we got into credit. We tried for years to convince the lending establishment that software companies were great credit, and after years and years and years, we were still paying 150, 200 basis points more for like credit because they were in software. And so we kind of shifted and we told our investors about it and said, hey, this is a great asset class for you to invest in, and they agreed. So that's how we got into it. You know, I think it depends on the space that you're in. I have seen, Vista doesn't do it, but I have seen some investors out of their private equity funds invest in credit. And I think for some of them it does make sense. You know, the godfather of the balance sheet, this is his conference, so he knows more about this than anybody, but in times, maybe even times like these, in certain industries, you're better off investing in the credit because it gets you a better risk reward. I think it really comes down to what industry are you in and what is the purpose of the vehicle and what return threshold are you trying to give to your investor base. I don't know, David, you guys have the same.
Yeah, we have a big credit operation, and some of the other guys do. It turns out that the hardest part of private equity is the working with the companies piece of it. And if you look at what happened here, all these guys who are now big in the credit funds all started out as private equity firms. And they saw a gap, that Brian pointed out. They saw a gap and went to fill it. Because it turns out the credit business is a lot easier than the private equity business. You don't have a lot of guys who started as debt funds coming into private equity, but you have a lot going the other way around. So the only guys I can think of who've been successful in the private equity business who started as debt fund is Apollo, who started off as a credit fund, but nobody else did.
Yep. Okay, let's move to emerging markets, and then I want to touch on China, too. And there's been a lot of discussion over the last day and a half around emerging markets, as we said earlier, and contagion risk, and et cetera. David, I'm going to come to you first on this topic. I think in the private equity world, if you look broadly across the emerging markets, you're about as knowledgeable as it comes. There may be some people on specific markets, but you've got a great broad view. And you were on a panel here last year, specifically on emerging markets. And I think Mark Wiseman from BlackRock was the moderator. And there were a few statistics that were thrown out at that panel, and I'll just rattle through a couple of them. And you probably all know these, but 85% of the world population in emerging markets, 60% of annual GDP growth comes from emerging markets. By 2025, half of the billion dollar plus companies in the world will be headquartered in emerging markets. Yet there was an estimate thrown out at that panel last year that the typical investor has about a 5% allocation to emerging markets. Whether that's right or not, I don't know. And look, we see the jitters. We've seen the jitters over the last few weeks, and we've heard them at the conference. But for the long run, that can't be right. So a big answer to where the capital goes has to be emerging markets. So I'd just be interested to get your view first, David, on how you think about the different emerging markets. I know it's not just one pot, and where you see the opportunities.
Well, every emerging market, the United States included, has its moments. And they're all different. And you got to understand the politics and the culture of each of those places. We operate globally. We pretty much operate anywhere where there's an intelligent deal to be had. But the underlying principle is actually pretty simple, which is when life is good, people want to invest in emerging markets because the returns are higher. The risk is higher too. And the risk may be too high, but people tend to want to invest in emerging markets. When life is not so good and the fear factor replaces the greed factor, people want to go to the United States, particularly in times of a strong dollar. And what happens is cash flows away, and that's what's happening now. It's just started, but it's happening now. Yeah. It is 100% predictable that that's what's going to go on for a while until people's views of geopolitical fears and others change, in which case cash will flow back to the emerging markets. Now that doesn't mean that some market here or there isn't a good opportunity for those of us who are effectively in the deal business. And just because China is having its woes for the moment doesn't mean Vietnam isn't doing well. But as an overall matter, what I've outlined is the paradigm.
But it's finding the right pockets of opportunity. You did very well at TPG on a distillery in Myanmar, as I recall.
Distilleries are us. Got an even better margin than software.
There you go. That's a new niche.
We did a distillery deal in Myanmar, which worked out great. We did one in Turkey, which worked out even better. Right. I always buy liquor in a Muslim country. There's nothing else to do.
Other thoughts on the emerging market, Michael?
Yeah, so the emerging markets has probably been the most interesting call of the year. If I said to you in the beginning of the year that the U.S. market would be up at or near double digits, and on average the emerging markets would be down double digits, and China would be down 25%, I think nobody in the room would take that bet that that was going to happen. And a lot of it, as I think David alluded to, has to do somewhat with the dollar. Some of it has to do with a lot of tweeting and a lot of potential for trade wars. But it's just really interesting that in my career, the hardest calls for me have been on the emerging market side. I was in Brazil in March, and we met with probably 25 different companies and hedge funds and long managers and government officials. And it was the most sanguine that we had seen that country probably since the financial crisis. And we left the country and the market just went straight down. And I think a lot of it continues to have to do with the dollar, and it has to do with the potential for trade wars. And in that country in particular, it has to do with the political situation but it's been very difficult. India probably being one of the outstanding markets that has been able to be above the fray. But I think that the situation doesn't look like it's going to turn in a big way over the next year, given the political climate and the geopolitical climate. I'm personally a little bit worried about the outlook for emerging markets over the next 12 months.
Well, you should be worried about it because the signs are in the wrong direction.
Thank you.
But the signs are obvious.
Brian?
You know, these guys know more about this stuff than I ever will. You know, from a micro standpoint, though, as it relates to technology, I think one of the reasons why in these emerging markets you haven't developed an appetite for buying packaged software is because of currency fluctuations. It's simply been too expensive over the cycles for these countries and the companies they're in, and except for their biggest businesses like banks and hospitals and whatnot, to be able to afford this dollar-denominated stuff. And so what you find in most of these emerging markets is they've developed this very large tech services part of their economy because it's predominantly labor-based, which is in local currency, and they kind of grow up their own nascent technology industry built around services and bespoke software. And it'll be interesting to see, you know, how that impacts as the cost, as David said earlier, of creating this technology continues to go down. It'll be interesting and maybe exciting to see new software being developed and new software companies being developed in some of these emerging markets, because it's not that expensive to build a company anymore.
Yeah, that's a great point. When you think about the public versus private capital markets in emerging markets, I mean, the public markets aren't always the best indicator of where value sits, right? I mean, that's something that's come up this conference and probably came up last year.
So what happens in emerging markets, with a few exceptions, is that the so-called providers of liquidity don't really provide any liquidity. So if you go to Brazil, the Bovespa has a few companies that are of any size, but basically nothing trades. The exception is India, which has a very vibrant public market, maybe too vibrant, and it makes it hard to get anything done in the deal business because the prices are always out of control, or often out of control. Plus, they have some regulations that make Sarbanes-Oxley look intelligent. But that's a fallacy, and that's why private equity actually works better in these markets than public equity does, because you think you're getting liquidity, but you're not. So you might as well face up to it and then structure your deal in a way that you know you're not going to have liquidity for a while.
Let me throw out, I know it's not an emerging market, but Japan. You hear a lot of people talk about Japan as an area of opportunity, a destination for capital over the next few years as some of the trading companies deconsolidate and look at their portfolios. I've heard other people say big risk, over-levered. What's the view on Japan?
I guess I'll start on Japan. I've been visiting the country for about 15 years. And as a growth investor on the public side as well as the private side, I've always found it to be a very challenging market. They don't have that foundation of entrepreneurial spirit that we see in the US and China and India and places like that. So you don't see a lot of new companies being formed. The country has critical demographic issues. The population is actually declining. They have no immigrant population to really supplant that. And so it's really, really hard to find growth in that country. So I don't see this, or I don't see Japan as one of the best opportunities on a global basis. I think they can play around with monetary policy and fiscal policy that provides some opportunities and flows into the Japanese market that will create nice gains from time to time. But of all the markets that I look at, I find it to be one of the least interesting.
So I want to second everything you've said. It's absolutely correct. And I'll give you an anecdote which tells you anything you need to know. A few years ago, we bought the world's largest maker of diapers. It makes diapers for all the majors and had its own non-brand brand. Japan is the only country in the world where adult incontinence diapers outsold baby diapers. That tells you everything you need to know about the prospects for Japan.
So you're telling me I should cancel my trip to Tokyo next week? Okay, apologies to any Japanese citizens in the audience. China, I said we'd come back to China. And again, I almost hesitate to refer to China as an emerging market, but a lot's been said over the last day and a half around China, the trade tensions with the US, whether China waits out to see what happens in the White House in the US. What's the sentiment toward China? Dave, we'll start with you.
Well, I think you have to take a longer view. The Chinese have done an economic miracle over the last 30 years, probably the most effective set of economic policies in the history of the world. So you can't fault them too bad for making a short-term decision on what they're going to do with their currency. And the problem we're having with China is they have too good a deal in the WTO. And that was a deal that made a lot of sense when they were a poor country struggling to get out of the revolutionary aspects. But that deal doesn't make any sense anymore. And they have a lot of rights and privileges under the WTO that nobody else has, including forcing people to transfer technology, all this kind of stuff. And that has to change. So I hate to admit it, but Trump is right. Not necessarily in his tactics, but his complaints are valid. Having said that, you got to bet with China in the long term. They've got a lot of people, they work hard, they're not hampered by religion like other places. And by and large, they've done great. I mean, anybody who summed up that track record over the last 30 years would be pretty proud of what they've done. So will we disagree about currency valuations in the short term? Sure, probably. Does the WTO need to be changed? Yes. All that's true. But in the scheme of things, you got to be a bull on China over time.
Brian, China continues to raise its game in technology and become a major player. How important of a market is it for you?
They're so important. I mean, they're important now. The quality of the code and the technology that's being built in China is absolutely on par with many of the best companies in the US. And frankly, when it comes to things like consumer internet and mobile, they're even better. And it's something that a lot of American companies need to face up to. The issue that David alluded to for us is a very valid one around IP. And that's part of the challenge of making the right investments in China. And you want to be careful because you want to make sure your lawyers aren't keeping you from doing great deals. But you also have to be cognizant of the fact that when you're in the IP business, if somebody walks out with your code and decides to create a competitor, you just have fewer rights as an investor than you do in some of the Commonwealth countries in the US, obviously. So, but from a customer standpoint, China has emerged to be one of the most important markets for our companies, from code development, employees, the quality of the educational system, all that is tremendously impressive. And as David said, in the long term, there's no question that China is going to be at least as important as the US in the long-term technology industry.
Michael, agree?
Sure, and what I would add to that is that I think this fight around tariffs and a trade war is really a much bigger strategic issue for the most part. And it's really about dominance over the longer term in terms of not just trade, the size of the economy, space, exploration of space, cyber wars, and things like that. It's a lot of that that's being captured by this. And this is what the United States is trying to talk about, not very eloquently, and probably not in the right tactical manner, but it is a much broader strategic issue that the US is trying to deal with. It's also including the South Seas and who is going to control that. And so it's going to be one of these areas that we've seen over history, whether it was in the early 1900s with the US versus the UK, or in the late 20th century with the US versus Russia. We're now entering that period with China versus the US. To me, I think there's a much better way to get there, and it's inevitable that China will probably be larger, not probably, will definitely be larger than the US. They're on a great path. They have 3.5 times the number of people, so it's inevitable, but I think that we should be figuring out ways to work more closely with them fairly so that we can take advantage of that, whether it's our technology companies or any other company in other industries that can take advantage of a market that's going to be a lot larger over the next 100 years.
Hard to disagree with that. Okay, I said we were going to try and take 10 minutes for audience Q&A, so we're pretty close to that. I want to open it up to the floor. Yes? Do we have any? There we go. Microphones.
Yeah, I think, at the outset, David said that at the time of great geopolitical risk, you look to invest in things that are more apolitical. But my question is, what is apolitical today with, rising nationalism, populism, trade wars, foreign ownership restrictions? I mean, it's impacting, at least from us sitting here in Singapore, everything, supply chains, investment. So what is it that's apolitical that you can invest in today?
Seattle hockey.
Great answer. Any other?
Well, yeah, I would say I didn't say that I would only invest in apolitical things because I think it's hard because you think about a company like Uber, which you would think is a very apolitical company. They're picking up people and they're dropping them off, but then their former CEO starts talking about various issues, whether it's around Trump, whether it's around the Me Too movement, and all of a sudden they become a political company. And my daughter, eliminates the Uber app and has yet to go back to it. And so, to your point, I think it's hard. I'm not trying to invest necessarily in apolitical companies, but we want to invest in companies that are are addressing all different populations and all groups of people and are gender diverse and are ethnically diverse. But I think that sometimes, unfortunately, by happenstance, you might end up with a company that ends up in the political fray because you have a very vocal CEO, and most CEOs have large egos, and they can get themselves in a position where you go from apolitical to very political very quickly.
I think that's true, but I think it's also true, and Brian can correct me here, that the companies he's investing in are not ones that are likely to be attacked by the president for this or that or the other thing.
Mm.
Yeah. I was going to say, we just try and stay boring at Vista, which for me is not that hard. But the key is staying under the radar. I mean, we may be building technology that does change a lot of people's lives, but you alluded to a certain CEO. I mean, some of these folks, and I'll say guys, because it's almost always guys, go out of their way to put themselves in the political crosshairs of certain groups. And I think, a certain generation of CEOs now feels like they are statesmen and they feel the need to opine about everything. And sometimes we just need to shut up and go back to work.
Good advice.
7 minutes and 10 seconds from now, that'll be us.
Yes, sir.
Question in the back of the room?
Yeah, thanks very much for taking my question. Back to the question on where you think capital will go. It seems interesting that you've talked about less capital-intensive industries today. On the other hand, you have massive power of concentration amongst the FANG companies and also the social media companies in China dominating platforms. They can invest and retain those customers and markets with that huge reach. Plus, they have the ability just to buy companies, and compete with you. So, how do you square those two trends? And is this going to be a limiting factor in terms of opportunity?
Take that one.
I think a lot is made about these technology companies, especially in consumer technology, and how much power they have. I think the reality is it's not like, the local Pullman store where you have to buy everything there. Take Facebook. People voluntarily, I'm constantly amazed, and I talk to my wife about it. I'm just amazed at how people voluntarily give product to this company. You're constantly giving your data. You decide to spend all this time on it. You convince yourself that it's important to do so. And they've created this currency of likes and popularity that is completely unnecessary to the way we live today. But somehow they are now getting scrutinized as a monopoly. And I think it's very different than perhaps the way people used to look, the way certainly the European government used to look at Microsoft, where their operating system at the time, the 90s, for a period of time, was the onboarding mechanism for the digital economy. And so I think people make a huge issue about this stuff. You can disconnect. And like you said about your daughter with Uber, I mean, Uber has 70% market share in ride sharing. They left the Austin market, and my good friend Joe Lemont built an application for $800,000 that the entire city of Austin used that mimicked the functionality of Uber for a great period of time. And then when Uber and Lyft were allowed to come back, 70% of the people decided to get back on Uber and Lyft, but they chose to do it. And there was, other than perhaps the convenience of going to the app that's the third one to the left as opposed to the one that causes you to move a page, there really isn't any other reason that people needed to do it. And so I think people, there's a lot of hysteria around it. Now, Google's a whole separate issue, and we only have 4 minutes left. But I think a lot of these consumer applications, the idea that there's only one thing, Facebook's 10 years old, 12 years old, and my guess is in 12 years, we're not going to be talking about them in the same way as we are today.
So the politics are beginning to creep into these businesses. These businesses were founded on the American ethics of antitrust or lack thereof, and the Europeans think quite differently. There's starting to be fines, there's starting to be sanctions, there's starting to be rules. The entire field will look a lot different 10 years from now, is Brian's point. And he's right. You'd start seeing articles in the Wall Street Journal about the new antitrust law enforcement and the new theory of maybe it's not all about consumer pricing, it's about monopoly. You know, the government once went after Microsoft for things that we now think of as trivial. So the political field will change. And I'll wager you all that 10 years from now, you won't have the same dominant people that you have now. It's inevitable.
One more quick question if we have one. Yes. Right.
I'd be interested in the panel's views on the outlook for inflation, given that the world is more indebted today than it was 10 years ago, although the composition of the debt is now held by governments and households more so than corporates. But nonetheless, it's one way, inflation is one way to inflate our ways out of this debt bubble.
So in case everyone couldn't hear, the question was view on outlook for inflation.
So I'll take the first stab at that. So I think just thinking more acutely in the US market, I think inflation is very likely to go up and to the right. And think about the US, really the biggest driver of inflation is going to be wages. 70% of the economy is driven by labor. And we have almost record levels of employment today and very low unemployment. And so we're starting to see that pressure. And so I think that one, from low unemployment, we're going to start seeing wage inflation. And then clearly, if the tariffs continue to take hold, that's going to be very inflationary. So I think there's more drivers now for higher inflation than we've seen in over a decade.
Probably not much disagreement on that.
Yeah, I'm always so confused by how consumer inflation works, candidly. And David is way 100 times smarter than me generally, but especially on this topic, so I want to hear him. But, you know, part of the reason why this administration won 2 years ago is because the American middle class can't afford anything. And the things they care about, healthcare, education, housing, is completely out of their reach. And you've had massive asset inflation over the last several years, and yet it's not picked up in the traditional metrics that people seem to understand as it relates to inflation. So David, maybe you can explain to me what the hell's going on.
I don't understand it any better than you do, other than 7 of the last 10 recessions were caused by the Fed raising rates. Then the danger here is the Fed. There is no inflationary pressure yet, and they're still raising rates. That's a very bad idea. I would just want to make one other point to the questioner's point. The most important thing about the debt levels is that they're held by different people. If you go back to emerging markets, they're all deleveraged compared to where they were in the last set of disasters. Same is true in the US. It's not the consumer that has so much debt, like the housing bubble in those days, although we're working at it. It's corporates and it's governments, which makes for more stability than when it's individual debt holders.
You know, Brian, I think we could have a whole separate panel on the topic as to whether economic indicators have kept up with
I just want somebody to explain
the fourth industrial revolution. So, all right, we're nearly out of time. Very quick, lightning round. What is your advice on the investment outlook for this group? Start with you, Brian.
Well, I think David said this multiple times, but you know, in an environment where there's a lot of dislocation, if you're a real investor, you have to look to the long term. And what are these long-term drivers? The idea that people aren't going to make a long-term bet on China or a long-term bet on technology that's not investment. You're hiding from reality. And so I think, the best way to get through this geopolitical uncertainty is to think not in quarters and years, but think about where you want your money to work as the world changes and as we, not just enter and transform our economy, but really persevere through this, fourth industrial revolution. So that's my recommendation. Look to the long term.
So, Michael, 30 seconds.
I think we have to be cognizant of the fact that we are very late cycle. We're 10 years into a recovery. I think the likelihood of having a recessionary environment in the next 18 months is very high. I do think it will be shallow, and I think it will be a great buying opportunity because everything that we've talked about around technology is going to remain in place for a very long time. And so I think that technology is going to continue to be transformational and disruptive, and that's going to last for at least the next decade.
David, final word.
I want to adopt what these guys have said are my views. No, there are times when the macro dominates. Anything you bought in 2010, if you didn't get defrauded, you look pretty smart a few years later as the economy picked up. Anything you bought in 2007, you didn't look so good. There are times like that. This is not one of them. This is a time where you've got to pick and choose, and it's something about the particular investment that you like. Because I think Mike is right. The odds of things not looking so good a few years from now are better than the odds of them looking so good to get there. But there may be something with some particular company or some particular place. And one of the reasons that healthcare is so popular among private equity guys now is because it's disconnected to the economy, particularly outside the United States. Everybody wants more and better healthcare. They don't care whether the Fed's in deficit or it's not in deficit. And so you look for businesses in spheres where it's not the macro what dominates.
Great advice. Gentlemen, thank you. And thank you all for being with us for the last hour.